Hey everyone, and welcome back to Financial Fix Blueprint. While stores fill up with decorations and your annual to-do list gets shorter, something else is moving fast. The stock market and the economy. The final stretch of the year from October through December isn't just about holidays. It's a period full of recurring financial patterns that affect our investments and our wallets. Today, we're breaking down the key events and classic year-end market moves. Understanding these patterns isn't a guarantee, but it's an excellent way to be a more prepared investor. The Santa Claus Rally. The most famous pattern is called the Santa Claus Rally. What is it? It refers to the market's tendency to experience gains during the last 5 trading days of the current year, and the first 2 trading days of the new year. Why does it happen? There are several theories. The most accepted is that trading is done less by professionals who are on holiday, and more by retail investors who are generally more optimistic, or that tax loss selling is already finished. There is also the general effect of holiday optimism. The key: it's not a year of spectacular gains, but it is a statistically significant pattern. It often signals the optimism setting up for the new year. Tax loss harvesting. This phenomenon takes place in November and early December. What is it? Investors, especially professionals, sell assets that have lost value. They do this to offset taxes on gains realized from other investments to reduce their tax bill. This mass selling can exert slight downward pressure on certain sectors or stocks in the late fall. The opportunity: once the deadline for lost sales passes around mid-December, the selling pressure eases, which often contributes to the market's upturn, the Santa Claus Rally. The impact of mutual funds window dressing. The end of the fiscal year for many mutual funds is in December, which leads to window dressing. What is it? Fund managers buy high-performing stocks, the winners of the year, just before sending their reports to clients. At the same time, they sell their losers before clients see them. This doesn't affect the overall market much, but it can cause slight inflation in the prices of high-performing stocks in late December, and sometimes pushes low-performing stocks down, to make the portfolios look good for clients, although it's not a practice that benefits the long-term investor. Real economic trends, retail and Fed decisions. In addition to market patterns, there are key economic factors: consumer and retail. The last quarter, Q4, is the most important for retail. Sales reports from Thanksgiving, Black Friday, and Christmas are released in December and January, providing vital insight into consumer economic health. If sales are strong, the market reacts positively. If they are weak, it may signal a slowdown. Central bank decisions. The Federal Reserve Fed and the European Central Bank ECB usually have an important meeting in December. This is often their last opportunity to make significant changes to interest rates or monetary policy before the new year. Their statements are heavily analyzed for clues about the economic outlook for the coming year. So, what does all this mean for you? Maintaining perspective is crucial. Do not adjust your long-term investment strategy based solely on what might happen in a few short weeks. Volatility or sudden gains at year-end are just noise. Use this time to ensure you have done your own tax loss harvesting and to review next year's goals. If you enjoyed understanding these year-end patterns, hit the like button and subscribe.